Thanks for joining me today. So we're going to take a closer look at these oil markets. I've been watching the rally in the oil price and the corresponding moves in the equities. There's been numerous analysts that have been out, suggesting that we're entering a super cycle period for demand, which isn't going to be able to be met by current supply, which is going to translate into an even further surge in the oil price. So I would like to introduce our keynote speaker, Rafi Tahmazian. So Rafi is the senior portfolio manager at Canoe Financial. He's also the lead portfolio manager on Canoe's 3 energy funds, the income class, portfolio class, as well as the alpha fund. Rafi, the last time we had you speaking on our platform, we were talking about why oil prices had dipped negative. And it seems like for the longest time, the story really was, oversupply, Permian shale, and then, COVID hit, which severely impacted demand. And this time it feels like our conversation is going to be quite a bit more upbeat.
Yeah, for sure. It's a big change from the last time we chatted, which was pretty much a year ago. And at that time, we were really trying to understand if the balance of control in the supply, the global supply, was going to go back into the hands of OPEC, or was it going to remain a free market? And the good news is, for us as Canadians, certainly the control went back into the hands of OPEC or the cartel, and that's what you ultimately want as a Canadian investor. So that occurred, and the ability to rebuild in this environment started successfully. And so I'm really fast forwarding beyond all that now, and I'm going to do a quick presentation here, and I'm going to run through some slides in this, and I'm going to skip through others. Total time, Victoria, that you want me to speak is what?
Yeah, probably anywhere from 15 to 20 minutes.
Okay.
And then we're going to do a Q&A at the end. So, just to our audience, if you do have questions, you can, type them in the chat or type them in the Q&A box. And when Rafi is done his presentation, then we're going to do a Q&A, and we will get to all of your questions. So if you just want to hang tight and type them in there, then we'll get to them afterwards. So Raf, if you want to share your screen and you can go ahead.
All right. So this is the energy life cycle that I would have shown even last time when I was with you. We use this every time we present. We try to tell people where we think we are in the market. It's not a surprise March 2020 was capitulation. It was beyond capitulation, really, frankly. The sector traded at a valuation I've never seen in my career. Today, what's really happened is the debt restructuring went through very successfully through to about June of last year. And then we kicked off an enormous M&A cycle that is still going on today. And we anticipate without significant moves in the equity prices, we think that M&A will continue as well. And now even the investment community is getting involved, so you can see the flight to quality and liquidity. The large mid-cap sector is very active in trading. And really what would normally happen next, and Vic, you were part of this world with me too for some time, was a new equity market would typically open up at this time. But we're not going to see that this time as readily, for the simple fact that the industry is generating enormous cash flow right now, and they just don't need new equity. They're not being asked to spend multiples of their cash flow to grow reserves per share. The market wants the companies to stay flat. It wants them to take that cash flow that they're generating and either buy back their stock or pay down dividends or reduce debt. And that's exactly what's happening. And so by the end of the year, you're going to see an enormous amount of cash built up in these businesses. And the question now is, how is the market going to value these companies with this cash? But really, the issue today that everybody needs to focus on is demand and supply. It's not ESG. It's not this fictitious story about the terminal value of oil or alternative energy. It's not the new technology of horizontal drilling and all the opportunities it brings. It is simply analyzing fundamental supply and demand. Now, this chart tries to show you two things: short-term supply on the left and long-term supply on the right. On the left, you can see the drop in the Permian, the US basins. They were the ones that were providing a lot of this short-term supply into the market, and they were making OPEC lose control of the market. And so volatility in oil prices were created by that, because oil just became a free market commodity for about 8-9 years. But with COVID and the collapse in demand, it caused these companies to have to cut back their spending for a moment. And guess what happened? The decline rate just collapsed their supply. So you can see when you add up all of the production in the US, they were supposed to be, they peaked out at about 13.1 million barrels. They're running around 11 million today. The forecast for today was going to be almost 15 million barrels by this point. So there was an expectation, if the US could have kept going and there was no COVID, that they would have been running about another 4 million barrels higher in production than where they are today. That easily could have collapsed the oil price. So you can see how the short-term shale collapse was critical. Can they come back? The consolidations are causing there to be less entities out there in the US. They're going through a rebuilding phase. And also there's an enormous awareness of the discipline that the market wants in the producers to stay flat and not grow for now. So as prices get too high here and it starts to hurt the economy, you do expect some production to come back in the short term, but they have no ability to really ramp it up the way they had it before. There were 780, almost 800 rigs running at this point when they peaked out. And the amount of capital required to get that back up there and sustained is impossible. There's no calculator that'll operate that'll make those numbers work. So we're not threatened by the short-term supply. The longer-term supply on the right, you can see these are super majors effectively that dictate the scale of this. And just the fact that capital spending is dropping so dramatically since 2014. This was the super majors reducing their capital, focusing more on things like their facilities and downstream capital spending, and some direction towards alternative energy, and their complete lack of spending on longer term projects for oil, and that have caused there to be a threat to even the medium term supply now. So you don't have short term supply through the Permian, and you don't have longer term supply through the super majors. And that means that you've got to start, analyzing demand a lot more. So here's the medium term as well, the prognosis of what we think. This is a Goldman Sachs chart here, and I'll have you look at that later if you like. But you can basically see your offshore and your onshore oil production really shows a deficit of approximately 9 million barrels by 2025 in terms of supply to the market. And in terms of excess oil available on the right, that is OPEC on the right here. And in 2021 right now, we think their excess supply runs around 6 million barrels. So somewhere between 2023 and 24, we think we'll fall into a deficit of oil that runs between 3 and 4 million barrels. And a deficit in oil supply means probably more like an energy crisis created. So we do need to find some oil over the next 2-3 years that equates to about 3 to 4 million barrels, or we think we'll have oil prices spiraling up and possibly being a catalyst to create an economic slowdown. The demand side, these charts are a little noisy on the top, these 4 charts, but the bottom line here is trying to show the light green lines and the dark green lines. The light green are lower. That was last year. The dark green is higher. That's this year. And you can see basically the US is rocketing back towards their normal usage, and that was not a surprise to us. In fact, today we got even more encouraging news that their air traffic is heading back to normality as well. But what I want people to understand, and I had this on the chart, I think, when I spoke to you last year as well, is the one on the bottom here. It's very critical. The red line is the developed world. The developed world is where demand for oil has remained relatively flat for the last 15 years. The demand for energy is not flat. It's up 5-6% in that period of time, but the demand for oil itself has stayed flat. A lot of people would think that demand for energy, that increase, was replaced by alternative energy. That's not correct. It was actually replaced by natural gas. And you're going to have two groups on next. Crew is one of them that focuses on the natural gas side of things. And I would say anybody producing natural gas in North America today is in a very good position with both the LNG exports and the amount of infrastructure we're building to use natural gas. And so our increased energy usage is being offset by natural gas. The undeveloped world, the blue line, that's different. They don't have the infrastructure nor the gas to be able to offset their increased energy demand with natural gas. So they have to use oil. And there is a very robust demand for oil in those areas. There is not an alternative for them. The alternatives, we keep trying to be postcards in the developed world for the alternatives. And what we get is things that happened in Texas, or what happened in California, or what happened in Europe. California in the summer, Europe and Texas in the winter demonstrate that we're just not ready. The affordability of these alternative strategies is nowhere near where these undeveloped worlds can use them. The reliability of them is nowhere near. I mean, in the U.S., in Texas, it got a little cold and they had a cold shower. In the developing world, you have those problems and you get mass carnage and death. So that's not going to happen. You can see here the vast majority on the left side of usage is still coal, oil, and gas. All of this talk and the airwaves, we hear about windmills and solar panels, and they contribute all of 1.8% of global energy involvement. We got to get over that story and start focusing on how to attack these problems the right way. And it's certainly not with windmills and solar panels. You can see on the right here that the vast majority of the population is in Africa and Asia. And so those are the places where the developing world is. And you can see from the chart before I showed you, that's where the most of the demand growth is coming to. So the demand for oil is healthy. The supply is waning, and it sets the sector up very nicely. In terms of the markets, here's your bottom line here is the representation of the sector. It's crawled off the bottom from 2% of the S&P. It's now kind of closing in on 3% of the S&P. And so it just isn't an influence in the market for the investment community to necessarily feel like they have to be a part of it. A lot of people think they shouldn't be investing in the sector, but some people just don't think they have to right now. And as a result, it's kind of sitting there in the weeds with very few investors really focused on it right now. And that is actually an opportunity. It allows almost this recovery to happen somewhat in slow motion. And I don't want people to think that this market's gone too far too fast. The valuations of things, the sector is still very healthy. And in Canada, I think what it's really important to understand as well is when you start focusing on our energy index, you can see that over 70% of the index is represented by 5 names. And in fact, the amount of oil and gas companies in the index have dropped dramatically in terms of the numbers today versus where they were a mere 4 years ago. So you can focus on these four names: the Pipes, Enbridge, and Trap, and Pembina. Then you've got Canadian Natural and Suncor, the two big oil sands players. But really, I would tell people to check out the large cap and the mid cap sector. Two of the darlings in the group are going to be speaking right after this again with Kelt and crew, and recognize that the amount of exposure the market has on them is so little that you can be playing in this space without a lot of competition right now. Also, this chart kind of shows you what's happening. Here's some of the largest fund companies on the left in Canada, and this is as of December 2020. But they and the capital that they have exposed into the energy sector, and you can see on the right in the red box, the vast majority of their investment is stuck in those core names that are representing the index. So they're index hugging is what's happening, and the rest of the names are being ignored. And what I'm going to show you here, to my point about has the market gone too far too fast, and this is kind of the piece de resistance of the whole presentation really, is that red box kind of shows you that group that is in the index, and using oil prices at $60 and $70. And remember, $70 oil, I don't mean a point in time. $70 oil would be what we think the oil price is going to average between the middle of this year and the middle of next year. And based on that, what do these companies trade at when they if we use their average historic valuations using $70 oil? Well, that group that is in the index probably has about a 70 or 80% return ahead of it. That's not bad. But if you move into that intermediate sector, you can see that there's still between 250 and 300% return in that group. Crew is one example. If it trades at its average historic valuation at $70 oil, and you'll be hearing from Dale right away here, that there's a 500% return in that stock going forward here. So very lucrative for him. Kelt is coming up right away. You can see that's a 300% return to its historic valuations. Although Kelt does look a lot different than it did the last time it was in the market up there. But you'll be able to hear from them and see what kind of dynamic is going on there. A few other names in the presentation here. I'm gonna leave it there, and but there's some private equity names and some alternative energy exposure that our funds carry. These are some of the larger positions as well. Tourmaline and Paramount in our fund. Trican is energy services. What happens invariably when these companies generate a ton of cash, it means there is going to be some pressure to start to spend more in the field. The energy service sector has been decimated in this correction. And so any amount of increase in spending, you're going to see pricing power through the service sector. We think the first place that's going to come is the pumpers. And that's why we strongly recommend looking at something like Trican and maybe even STEP. Here's our portfolio and our subsector exposure that we currently have right now in terms of where we sit on our income fund. The energy class, really our focus right now is crude oil, energy services, and gas really are the focus for the group today. So I'll leave it there, Vic, and happy to take questions, or if you want me to sign off and go into the Q&A, I can do that as well.
No, we have some time, so let's do some questions live. I have some questions too that I wanted to start with, but I mean, thanks for the presentation. I think a lot of our audience and a lot of generalists, have really stayed away from this sector given the extent of the downturn. So it's just helpful to get an update on what the supply demand picture really looks like now, because it has changed quite a bit, from where it was when people left the sector. And I also found it really interesting just to see, how upmarket a lot of the large institutions are and have become. It just seems like there's a lot of missed opportunity right now in some of the smaller names. So
I think there's a lack of, Vic, better than anybody, the intellect around analysis and sales of the sector has been ripped out of the guts of the system in Canada. You left the industry. There are multiple people of your caliber that left the industry. The analytical side is very, very weak. And it's just the simple fact that there's a lot of pressure in the system to not be focused on that group. And the funny thing is they're not focused on it, but the usage has never been higher of oil. And so it just bodes very well for these businesses as a result.
So I guess I'll kick off a few questions and then we'll try to get to some audience Q&A as well. But, I think everyone's watching the economic recovery and, most of the major oil demand centers have really gotten past the worst of their COVID flare-ups and are coming onto the other side positive. But then everyone's watching CNN at the same time and you're seeing India and all of the problems that they're having over there. So does that worry you at all, or does that push back your timeline on when we would see kind of this surge in demand, or is it just demand so strong elsewhere it's not going to matter?
Yeah, no, that's a good question, because what I actually, another way I say it is, where is the downside in this thesis that we have? And there are these aberrations in things like what's happening in India. The market has been brushing it off. I think there's a little bit of breath holding right now to make sure that India can start to recover here and get the right focus. It's going to take a monolithic process to do that for them. So we are watching to see if it affects demand in the short term. But the market is really shrugging it off to this point. And it's just really, and it's shrugging it off in the sense that it's looking beyond it. The question is, how far is beyond, and how long will this linger, and will it start to kill the demand? We've seen no indication of that as yet. But I would say the biggest the risk to this sector is demand destruction. It's not some aberration on supply. Hopefully, I went through it very fast, that people will not fear that there is a supply shock coming somewhere. I would say, if anything, it's how do you erode demand substantially enough that you can cause there to be an oversupply. And this massive infrastructure spending globally that's going on, it's unprecedented, and it is a complete with complete disregard for the usage of oil. Oil is massively required for this infrastructure spending, and it's skyrocketing the demand for it currently. But if we get an economic slowdown, a massive economic slowdown, a day like yesterday in the tech sector, does it drag into the rest of the sectors and then take everything down? And is this finally the last leg in this long economic cycle that we've had for so long in the growth markets? It probably would have corrected had they not had that infrastructure spending. But as a result of that, that's the equivalent of, on a ratio basis, probably something similar to what happened in World War II in the spending that went on and created the economic boom after World War II. It's not dissimilar to that. And so it's revitalizing the economy and keeping things going. But that's, I would say, the biggest concern I have is not necessarily India. It's at what stage of the global economic cycle are we at? If there's a downturn, it turns down demand, and you see weaker prices then. But I think we got bigger problems than oil and gas at that point.
And then how are you thinking about this push for deurbanization? And, everyone's moving out of the cities. Everyone's got, new homes that they're buying. They need to heat, they need to furnish. They're now driving everywhere. Whereas before, maybe, they walked from their condo to the grocery store. Right. So how big of an impact is this going to have? This is almost a new pocket or an expanded pocket of demand that is new.
Not many people ask me that. And it is something we're working on, actually, to try to understand it. It is material. Car sales are through the roof. Used car sales is through the roof. The supply chain is broken, which is preventing all of that to get accentuated even more. We think if the supply chain wasn't broken like it is right now, you'd see even a more elevated amount of demand. You see a lot of the rural towns around the big cities starting to pick up in real estate. and people staying closer to home. And so we really just feel like there's an unknown amount of pent-up demand that's developed from COVID as a result of people moving out of the inner city and into these rural areas. So that's something we haven't been able to predict what that number will be, and we think it's still on the come.
Yeah, I mean, I live in the suburbs, and I always say I only go for a walk when I'm going for a walk. Like everywhere else, I have to drive. So, but it'll be interesting to see. And then I do want to get to some audience questions, and there are a few, around just the Permian and the supply side that you talked about, and in terms of, what do you mean by the market kind of wanting them to stay flat? And at some point, if we do see this surge in oil prices, it almost becomes unprudent for them not to try to grow. And so maybe just a little bit more clarity, since you did go through that section.
Well, first of all, I think this is the first time in my life and career, and I see Sadiq and Dave are on now too, and these guys are what you would refer to as thoroughbreds. Typically, the industry charges forward, spending multiples of cash flow to grow reserves per share, and that message from the investment community was loud and clear last year in North America, and to curtail that growth. And I'm not saying that I think that was a good idea. I think actually that was a bad idea, because I think that North American oil, and specifically Canadian oil and gas, is probably on a human rights track record basis the best oil and gas to produce in the world. And by vilifying this oil and gas in North America and trying to tell these companies to suppress that growth while the demand continues to grow, it means we're putting more and more control into the hands of these countries that are producing that we might refer to as dissident nations. And as they get more control and power of that oil, they're going to start to use that as a vehicle to get things they need. And that's going to create geopolitical risk. And so there is no geopolitical risk value in the price of the commodities either right now. And that is a further elevated amount of pricing increase that you will get. So at some point, that pressure has to come off, and they have to recognize the importance of Canadian oil and gas to the global market. And that's when I think you'll start to see pressure to see this sector start to expand its production. That might require different governments at that point.
Okay. And I do just want to read two more audience questions, because I think probably a lot of people are wondering the same thing. So the first one I'm going to read is, I hold two Canadian juniors. Both of them are generating free cash flow, but they're still trading at less than 2 times operating cash flow per share. So what is going to draw investors into this grossly oversold sector?
Well, two juniors, first of all, like I said earlier, early in the cycle, there's anxiety around investing. So there's flight to quality and liquidity. And so you see your integrated large cap intermediates. And it's not until later in the cycle, when people want to elevate their risk, that they start to chase the juniors. So that's number one. You've just got to wait for that group to go. Number two is not all cash flow is equal. Okay. You increase service costs by a certain number of value, and some of these companies, their free cash flow will fall substantially. Others won't. Others also are drilling up all of their inventory. A company that's got free cash flow today with a 3-year inventory is not going to get the same value as a company with free cash flow in a 15-year inventory. And so don't get too caught up. There are some people that talk about this free cash flow like it's a homogeneous thing. It's not. I would encourage people to go on Canoe's website, and my partner Dave and I did a free cash flow analysis webinar. It's about 20 minutes long to help people understand that not all cash flow is created equal. And I would advise you to go look at that and see the story, because I think it'll help you understand that not all of these things are created the same way. But but in the most generic sense, these companies are pumping out cash flow, free cash flow yield. And 30 years in the business, I've never said that word before. This industry doesn't do that typically, and so they're bringing down their debt, as I mentioned. They're increasing distributions, and what I tell a lot of the producers, and I would tell Dave and Sadiq, and I would certainly tell Dale as well, amongst others at Crew that you're going to speak, that as an investor in energy myself, I have no interest in them trying to spend money to figure out how to get new investors. I'm more interested in them taking that money and giving it to me. Distribute it to me, make your yield go higher, and make yourself look more, incent people to invest in you by chasing the stock price higher and the yield down. And I get the benefit from that. I don't think we should be trying to figure out how to convince new unit holders who don't want to be in the sector and vilify it. I'd rather that capital be distributed back to me in my hands. So at this 10 seconds, I'm more interested in the companies paying down debt and distributing capital to us, as opposed to trying to expand capital and production with that cash flow. It's a problem, and it's a good problem that producers have, to have multiple opportunities to use their money right now.
Okay, Rafi, last question, and then we do have to move on. So this is the last question we're going to answer live, but then Rafi is going to hang out and he's going to answer the rest of your questions in chat. So don't think that your question's not going to get answered. But Rafi, what would change your bullish view? What would you need to see?
Change my bullish view would be fear that the broader market is materially aging and rolling over, and actually, I'm not talking about the tech sector rolling like it did. The tech sector might be rolling, but it might be transferring over from the growth to value market. Like I said, infrastructure spending by governments is so robust right now that we feel like this global market economic slowdown is mitigated by all of this infrastructure spending. But my biggest fear is obviously demand destruction, which I don't think can really come from any other way but a global market slowdown. So for those people who are very supportive of the market right now that are listening and think that it has legs, you should have a material exposure to your basic raw goods and inflation products, and oil is one of them. For those who fear the market right now is overly robust and toppy, I don't think you should be. I think you should be hiding from pretty much everything right now, frankly.
Okay, thank you so much. I appreciate your time.